This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. I want to do a quick advert here at the start today. Tomorrow, our colleagues Brett Gibbs from BI and Anastasia Davies from Bloomberg NEF are going to be holding a deep dive webinar on the latest development related to renewable diesel in the US. So if you're interested in that topic, reach out to myself or anyone on this call and we'll make sure you get the details for that. So with that in mind, I want to kick off the conversation on mid-year outlooks, and we'll do a little bit on renewable diesel here in a moment, but let's start with the oil market first. Sally, I want to come to you, get your latest read on the crystal ball. And I will tell you, I was watching Matthew McConaughey on the Lex Friedman podcast the other day, and he had this great quote. He said, "Life's a mystery going forward, but it's a science looking back." Great analogy for the sort of business that we're in, but why are we where we are today, and what do you see for 2H?
Sure. Thanks, Rob. And I heard that quote and I thought it was great as well. And it definitely applies to the oil market, the way we look at it. Looking back at the first half of the year, kind of makes sense that oil prices did what they did. And it's once again quite difficult to be thinking about and trying to get right what's going to happen in the second half. But I think one thing that we might have gotten right is at the beginning of the year was that we thought the first half would actually look quite different to the second half, especially in terms of demand and potentially supply. We knew that demand would probably pick up a lot more in the second half, but still we were expecting a bigger revival in demand, especially from China, especially as they kind of reopened from the COVID lockdowns. And on the supply side, we didn't realize that we would actually see such resilience from Russian output, and we didn't actually realize that we would see Iranian exports going up rather than down. So with all of that combined in the first half of the year, there was significant pressure on oil prices, and we did have OPEC Plus, which has shown that it's going to be quite defensive and quite aggressive with its output cuts, and it tried to drive sentiment to the upside with its surprise output cuts in the last two meetings, which hasn't been enough to push prices above $80 a barrel. But one could argue that without those cuts, without the announcement of those cuts, oil prices would actually be even lower. So looking at the second half of the year, like what we're probably going to see is a lot of those voluntary cuts starting to unfold a lot more. With Russia, I mean, we know the output level has been quite resilient, but they have promised to keep up with the OPEC Plus cuts. They're part of the OPEC Plus cuts, and they had promised some retaliatory cuts as well. So those may come into play. And then if we do see, as we foresaw at the beginning of the year, if we do see the third and fourth quarter demand numbers much better than the first and second quarter, I think it's still a quite constructive fundamental backdrop for prices. But that being said, I think we are still going to be range bound in terms of prices. On the lower end, as I said, we've seen OPEC Plus, and which has shown us that they are going to continue to be quite defensive, and they will try to protect a price floor. I think ideally for them, that would be around $80 a barrel, which they're struggling to get up to, but it would at least be $70 a barrel. So if we did see even further slump in oil prices, I think we could just keep seeing at least Saudi Arabia promising more and more cuts. And on the upper end, there is the real possibility of a recession in the US and in Europe, which has been a major overhang on prices. And like I said, on the supply side, we always talk about OPEC Plus, but then within OPEC Plus, countries like Russia and Iran and Venezuela may keep continuing to surprise to the upside. So we may end up with these dark and unknown barrels where we don't know where they're coming from, but we actually do, kind of keeping the markets a lot better supplied than imagined. But all combined, we do expect prices to be range bound between at least $70 a barrel and probably around $90 a barrel in the second half of the year.
Okay, thanks, Sally. Fernando, I want to come to you. I want to noodle on this idea of range-bound pricing a little more. Is that how you see it? Do you think OPEC will be successful at kind of keeping the price in that range that Sally just mentioned? And what catalyst are you looking for that we haven't covered yet?
Well, I think the big question is really on the demand side, and Sally laid out the key issues, and ultimately China will depend on a lot of the Western recession, right? You can't have a recession in the U.S., which is the biggest export market for Chinese goods, and in Europe, without it reverberating into China. One of the things though that we, as Sally was saying, the things we've gotten right and wrong, it's certainly slowed down. The U.S. economy is certainly slowing down, but not as quickly as we might have expected. There was just an upwards revision on housing starts. Housing starts are probably one of the big underappreciated catalysts. It went to significantly up versus slightly up or flat, really, on the revision. We would have thought that the housing cycle here in the U.S. would have taken a turn for the worse already, given it's the worst affordability since the late 2000s for the consumer. But that's still not quite the case. And there's a lack of inventory of existing homes, which probably contributing to this housing start. So this may push off all of this recession fear slightly down. And one of the things we always talk about is how summer driving season is not about people driving to their vacations and driving back and forth to Cape Cod and the Hamptons. It's really about housing starts. If you look in the Midwest, for example, gasoline demand, the region goes from being a net exporter in the winter months to a net importer, and that's because you can't build while the ground is frozen. You can't lay a foundation in those conditions. So really, housing picks up, and housing drives a lot of those of that increase in gasoline consumption. So we still think it's going to be a smaller bump up in the summer gasoline months than it typically is, but it may not be as weak as we previously expected if housing continues to kick on.
Fernando, I just want to ask one quick follow-up. There was an interesting article by one of our colleagues today called China's Tourists Are Flying Again and Heading to the Boutique. One of the charts that's in this piece, though, is it shows the number of weekly flights that are international coming out of China, and it's just at this low boil, and then it just a hockey stick takes off. What do you make of that chart, and what do you make of the Chinese demand numbers? I know there's been a lot of uncertainty about where China's at post recovery, and do you see the demand numbers starting to pick up there?
Yeah, the demand certainly picked up, but it's not as strong as was hoped, as Sally was mentioning. If you look at the imports in China in May, they were still pretty weak, and they were down significantly versus expectation. The imports also down, even though it was actually the third biggest month for crude imports since the pandemic. So really good on crude, but the overall was still down, which tells you your own, its own story about where consumption and productivity is in China. I think that the hockey stick, it's really a factor of the lockdowns, and it certainly impacts on the jet side. But jet's a small component. Travel is a relatively small component. It helps at the margin. It's a matter then of, will that Chinese consumer continue to spend? Will there be any consequences to the Chinese consumer spending abroad that the CCP won't want to continue? It won't make the trend, but it certainly contributes to what we were saying in a delayed recession. At the end of the day, it's more dollars coming into Europe, it's more dollars coming into the US and Canada. So it helps stave off a little bit of those recession fears.
Okay, let's bring it over to Will Hares next. Will, I would be curious to get your take if there's any differentiation on the oil market context broadly, and maybe tie it into some of the service names. I'd note you just put out a new focus idea just yesterday that I think ties in with this discussion quite well.
Yeah, I think Sally and Fernando covered most of the bases pretty well there, but I think there is an interesting read through here for some of the services names. This is a sector which has just been beaten up pretty badly over the last few years, and for good reason. Obviously, massive capital spending cuts have occurred through not just from COVID, but pretty much from 2015 onwards, and we're just starting to see this turn. We're seeing this underinvested, global upstream sector in particular, picking up to pre-COVID levels. And so names like Saipem, which is an Italian, primarily offshore energy services provider, are slated to benefit, we believe. And this is going to manifest in this year, two areas for our focus idea. We think that that the company can beat their guidance and consensus currently on revenue and on margin. It's not a very complicated focus idea. It's simply that we are already seeing early evidence of strong operational performance from the company, alongside solid order intake, weighted to higher margin offshore business segments. And 1Q was already excellent proof of this already. The margin was at the highest level since COVID. And we think the 2023 margin delivery can hit roughly 8%. The company also has a really deep and diverse backlog, and particularly in its asset-based services segment. This hit nearly double-digit EBITDA margin in 1Q, which we think is a really strong sign of the quality and diversification of the company's offshore portfolio. And then just finally, this company had a particularly rough time through COVID, probably more so than any other offshore energy servicer. Saipem saw massive cost overruns, supply chain pressures, and just sort of overall poor navigation of the pandemic disruption, and this resulted in an immense backlog review and heavy write-downs. But since then, the board has put in place a new team, organizational overhaul, and we think so far so good for delivery. And we're looking for Saipem to not only beat their guidance this year on revenue and EBITDA, but also consensus by at least 5%.
Okay, thanks for that, Will. For anyone who doesn't know it, focus ideas are our highest conviction, most differentiated calls. We're basically looking for companies where we think consensus is off the mark. And so take a look at that. You can type BI space focus on your terminal and pull it up and take a look at all the ones that we have out there. There's quite a few. So with that, let's turn it over to Patricio. Patricio, I know you've got a little different angle here, looking more at the gas side of the equation, but crystal ball wise, how does the 2H appear to be shaping up for the European gas market?
Yeah, thanks, Rob. I think the story is not very different from the oil story, with the, I'd say the major difference that it's seasonality. And while prices have normalized through the first half, reaching about 25 euros a megawatt, when the long-term average is around 22. So they pretty much grasped the normality since the start of the war. But we have seen evidence that prices are still highly sensitive to both supply side disruptions, such as last week we saw extended field outages in Norway causing a spike in TTF prices in the Netherlands. And at the same time, more recently, over the past few days, we've seen news that higher than average temperatures, or sort of an early onset of summer-like temperatures in Europe it's sort of spiking gas prices as well, because there's a increased need for cooling and refrigeration and energies, basically. So these does sit out like a very I'd say a still very tight supply outlook, considering that the region inherited above normal storage levels, and that sort of inheritance of ample storage will help us just about offset a wider Russian pipe flow gap in 2023, given that Russian flows are still only at 15% of what their capacity was in 2021. So if you consider that those two things will offset each other, and there's only limited upside from LNG, meaning that we won't be able to pull a lot more LNG than we did in 2022, given that we basically doubled our LNG imports in 2022. Given that outlook, we do see upside risks into the second half, particularly in the fourth quarter, given that traders will wait to see how the storage situation shapes up right before the heating season. So we do expect upside into the fourth quarter mainly, but we do have to caveat that we don't think there will be any sort of similar levels of volatility that we saw in 2022. Average prices for European gas in 2022 were about 130 euros a megawatt. And this year we see somewhere in the forward curve, somewhere around 30 versus consensus forecast of about 60. So we do think that there's a wide range, but as you can see, we don't expect prices to return to their highs of 2022.
If just following up there, so if the market is constrained on the LNG import side, and we anticipate no additional gas flows from Russia on the pipe side, does that mean that the market has to clear based on lower demand essentially? And I'll just say that all of us are quite active on Twitter. For anyone, if you're not following us on Twitter, we're easy to find, and we've been posing some questions. And one of the questions we popped out there today was, what is the trajectory of global gas demand look like? And it's just been rising relentlessly year over year, but maybe Europe bucks that trend. So curious, what's going on with Europe on the demand side going forward, Patricio?
Sure, I think that's perhaps the most important part of the story, given that we managed to exit last winter with above norm storage levels, roughly 20% ahead of the norm, but that is unsurprisingly met with a reduction in demand of about 20%. So the EU Commission set out a target to reduce gas consumption by 15% versus the long-term average between August and March. Last August and last March, and the region sort of overshot that with gas consumption down about 20% versus the long-term norm, and we did expect this to sort of start to normalize after March, but it surprisingly hasn't. Which means that we may be seeing sort of a structural shift in demand. We do know that Europe is very much focused on carving out gas demand, both via energy efficiency and also by the deployment of more renewables and the electrification of heating systems. But it seems like that the war in Ukraine probably accelerated this shift in demand, given that demand is still, as of May, about 15% below the long-term norm, and that's mainly a cause of a rebound in hydropower volumes, but also unsurprisingly an acceleration in the penetration of other renewables such as solar and wind, which means that power prices have also declined quite fast in the past 6 months, which means that if anything, the war probably accelerated the longer term trend or downshift in gas demand in Europe.
Okay, very interesting. I do think that that's probably a stark contrast to the global perspective, and so for that, let's think about a little bit about the context on LNG. Will, I want to come back to you and sort of think a little more on gas for some of your integrated oil companies. Last year, you had a really compelling thesis and a focus idea on how gas could really play a big role for Equinor. But what do you see for the gas equation and the LNG side of the story, particularly for some of the integrated oil companies? As they're deploying CapEx, I think a number of them have said they're going to place more emphasis on upstream and traditional oil and gas type investments. Is that going to be more gas weighted or more oil weighted in the near term, do you think?
Yeah, thanks, Rob. So this is a pretty simple response for the Western energy majors, or particularly the Europeans. And I think a good example of this was in Shell's Capital Markets Day last week, in which literally their first slide in the presentation was on the evolution of how fossil fuel demand is looking down to 2050. And the number one point they made, or the Shell CEO, Wael Sawan, made, was that hydrocarbons will be critical for energy security for the foreseeable future. And in particular, that LNG will continue to grow and displace coal as to provide a lower carbon energy solution. And then, of course, as time goes on, low carbon molecules will really accelerate and really eat into coal from a primary energy consumption standpoint, and will roughly comprise about half of the world's primary energy mix by 2050. But with that being said, gas and LNG, the contribution will, at roughly 20%, will stay pretty much the same for the next 30 years. And of course, that will require significant investment. And yes, you're right. In short, gas and LNG investment is comprising a larger share of CapEx for these companies moving forward over the next several years, particularly as opposed to oil, which is dialing back a little bit.
Fernando, given the differentiated pricing for Henry Hub in the U.S., is gas as exciting of a business from an upstream perspective in the U.S.?
I think so. I think there's still a lot of moving parts, but in the longer term, gas exports through Texas and Louisiana make a lot of sense. And while we don't think you'll get to the same levels for Henry Hub, because it's landlocked and it's the hub as opposed to the actual export market and their transportation costs, we think that the days of sub $3 Henry Hub are likely done. Doesn't mean we're going to go back to the late 2000s where we were 10 plus, but sub $3 are probably a thing of the past. We'll probably be around 3 to 5 for the long term. And then there are some other areas that will have some constraints, notably the Permian with Waha, and whether you can get all that natural gas out of the region, and especially with limitations on flaring and methane emissions that companies are setting, that creates a lot of additional supply that will have to find its way to the coast to be exported. The one big caveat is, can we get the pipelines built? There's been a lot of difficulties building new pipelines, especially interstate pipelines. Louisiana will need those in order to build some of these LNG facilities, and even the licensing of those LNG facilities faces some risks. But overall, we think that the supply of LNG from the U.S. will continue to rise, and that will give incremental demand and put a new floor on Henry Hub.
Sally, just to get your perspective from the Middle East, what's your sense? I mean, is gas still sort of struggling to find its role there? I know there's a bunch of new refining and chemicals capacity going into the region. Is gas going to be used for some of those purposes, or is there an export angle? How are the folks in the Middle East thinking about it?
It's certainly growing in importance in the Middle East. I mean, the Middle Eastern producers have historically been focused on oil. This is generally the most lucrative business for them. But gas, I mean, especially non-associated gas, is growing in importance in terms of capital spending plans, because in places like Saudi Arabia and the UAE, I think that's partly to be used domestically in bigger amounts, so that there is actually more crude oil that is freed up to be exported. LNG is a possibility, but that would be new for countries like Saudi Arabia and the UAE. Of course, there's Qatar, who is a big natural gas and LNG producer. But I think for Saudi Arabia and the UAE, hydrogen, blue hydrogen, is something that they've been talking about quite a lot. And I think a lot of the potential natural gas production could be diverted for hydrogen and for blue hydrogen. So it has not been as important for some of these national oil companies when you compare it to some of the Western peers, but it seems like it will keep growing in importance.
That's a great layup to come over to Patricio. Patricio, as part of your mid-year outlook, you've got a note that's titled "Hydrogen Pivot Could Curb Stranded Asset Risk for Gas Utilities." So tell us what's going on there, and what do you make of the hydrogen idea that Sally was just bringing up?
Sure. I think yeah, we published a note on our regulated gas utilities. So that's Italgas, Snam in Italy, and Enagas in Spain. So and there's others like Fluxys in Belgium as well. But basically, what we're trying to note is that all these operators of gas infrastructure assets, mainly distribution and transport networks, face immense stranded asset risk from a flat to declining outlook for demand in Europe. And although the picture might not be the same as in the rest of the globe, where the carving out coal represents a growth vector for gas and emerging economies, in Europe, it's pretty much at another stage where gas seems to gas use seems that it's poised to decline, and that's seen in policy and also in the incentives, both fiscal and policy incentives to deploy the capital necessary to modernize the networks and grids, and that's mainly that contrasts a lot versus the power peers. So you're talking about the Terna and other integrated peers that have like National Grid, which have power weighted network assets. So they will see both faster growth than their gas peers, just because they can spend more. They have access to cheaper debt as well on an easier basis. More of their investments are aligned to the EU taxonomy, which is a key filter to get access to the EU recovery funds. So all these sort of factors combine to make their long-term, sort of the gas utilities long-term outlook a bit clouded, I'd say, in the long run, especially to 2040. So many of these companies have announced plans to pivot or to transform their networks into hydrogen-ready networks. But we do have to flag that is still at a very early stage. There's only a handful of pilot projects that have not yielded very, very promising results as of now. In general, it's a lot of studies have actually suggested that green hydrogen may not be the best solution for heating. So that makes their strategies or their long-term view a bit more questionable or less credible, perhaps. And we do see them sort of pivoting away from those ideas of green hydrogen, now also trying to sort of laid their eggs in different baskets like biomethane. A lot of them are also investing in water services and energy efficiency and decentralized energy. So mainly we're seeing a major diversification into different small pots, and with the main point being that all these small pots of new energy are not regulated yet. So that means that these highly regulated entities, which were utilities at one point, are shifting towards a higher risk profile of unproven technologies at an early stage. And we do flag that in most long-term energy scenarios, hydrogen in any form is not expected to make up a meaningful share of the energy mix until after 2040.
So long duration kind of question for sure. Fernando, I want to come back to you real quick for a comment on another part of the renewable or clean energy space. You've been working with Brett Gibbs to put out some notes on the RFS in the United States, and you've got a note just the other day saying Valero, Phillips push to renewable diesel, headwinds mounting. So tell us what's going on there, and what are you looking for as part of 2H?
Sure, it's very, very topical because we just had the RVO, the Renewable Volume Obligations released yesterday. I'm sure Brett will cover it on his webinar tomorrow. But RINs, the renewable fuel credit, the most common variety of it is down over 10% today because the increase in quotas was very, very low, and much lower than expected. And there are a couple reasons for that. First, EPA is slow to move and slow to address what's obvious, which is the increase in biomass-made renewable diesel. But two, the big headwind that we see coming is that there is an oversupply now of renewable diesel relative to the feedstock availability. And Neste, the Finnish renewable diesel producer, just came out yesterday saying their growth is going to slow down because exactly of that issue on feedstocks. And we see that plaguing the industry as a whole because the main feedstock is used cooking oil, but also virgin seed oils that compete with animal and people food stuff. And so that leads to food price inflation, which obviously most governments would loathe to do. So we see that hitting a zenith now, and then as we get into the 2024 cycle of RINs, there will be that oversupply of D4 RINs. It's already the gap between D4, which is a renewable diesel, biomass-made renewable diesel, and D6, which is corn-based ethanol, has already narrowed significantly. And because of that oversupply, especially without an increase in the obligations, that could push the whole complex down significantly because they are interchangeable. And with that, that price would come off significantly. The margin for producing renewable diesel in the US would come down significantly today. It basically depends on RINs. And some of the merchant refiners like Valero may actually get a benefit on their refining side, although a lot of them produce renewable diesel, so they would lose on that end. I think net for Valero is still positive. There will be some shakeout in this industry, and they are one of the better producers in the market thanks to their partnership with Darling Ingredients and Diamond Green Diesel.
Thanks, Fernando. For anyone that wants to go deeper, I've dropped the registration link in the chat for tomorrow's broader discussion on this specific topic. I think we should do a quick round robin for the most interesting idea you are watching for in 2H. I'm going to go first just to give everyone else a second to think. But if you look at the solar industry, we think it's going to be or to remain the fastest growing segment within the energy space, be looking for demand to grow something like 30-40% this year. And we also are seeing an improving margin environment because we've seen some real decline in some of the key input costs for the industry. So Sally, let's come over to you. What are you excited about when you look into 2H?
Not necessarily excited, but I think it's going to be very interesting to see where Russian output goes. I think this will be key for the oil market balance. That being said, this has become a number that's very difficult to follow. I mean, they stopped reporting these numbers, but we're trying to kind of compile as delayed as it might be. And as I've mentioned earlier on the call, it has been quite resilient, but it's very important where that goes for the oil market balance, but also for OPEC plus policy, because I think if they just keep producing at will, producing at maximum capacity, this will bring a lot more tension to the next OPEC plus meeting, which might be a lot more interesting in terms of what happens to the group policy and strategy. So that's something that I'll be watching very closely in the second half.
Will Harris, let's come to you next.
Yeah, so I think taking a look at the North Sea E&P, this sector has incredibly strong headwinds, not least because of the energy profits levy that has been passed by the UK government. But I think that that the window here is opening for potential acquisition of some North Sea E&P companies. Even a private, I mean, Total Energies was rumored to be, taking a poke at Neptune Energy, which is a pretty large private E&P in the North Sea at around 130,000 barrels a day. The conditions feel right, and I think we could see, some of this excess free cash that's been generated particularly over the last year for these big European energy majors to be deployed into legacy oil, particularly because valuations in this area have suffered so badly.
Patricio, next to you.
Yeah, so I think there's two topics. One is within the power generation side. We do want to keep a close eye on certain policy catalysts that might come into place in Europe in the second half, which is mainly the Parliament affirming a target to increase the region's renewable aim from 32% to 42.5% by 2035. That should be a catalyst for a select numbers of independent power producers who did benefit during the 2022 power price run up. Although, yeah, that hurt most utilities. There are a few generators that could redeploy that capital. So we do want to keep an eye out on that. Mainly in Germany. There's a few names there that could have a bit of cash flow muscle to do something interesting there. And on the gas side, switching to gas utilities, as I mentioned, there's we're sort of in this path of structural demand downturn for gas, and that is reflected in receding remuneration or regulated revenue for some of the operators in Southern Europe, and we do expect that pressure to translate in reduced scope for payouts. So we will definitely be looking at that as well.
Fernando, over to you for the last word.
Well, I think the biggest aspect is demand, and whether this was a pause or it was a skip from the Federal Reserve, how housing fares in the summer, and ultimately how gasoline fares. I think that will be a leading indicator as to where our consumption will go. And so just curious especially on housing starts, and then on gasoline.
All right, we'll have to leave it there. I want to thank everyone for joining us today. Feel free to reach out to any of us with follow-up questions. We're all easily found on the Bloomberg terminal, and we're happy to chat with you about any of the research or topics we discussed here today. Again, we hold these on the first and third Wednesday of every month, so we look forward to seeing you in early July. Take care, everyone.